Chapter 31, ratio analysis. When we talk about ratio analysis, we are simply talking about putting different accounting ratios, comparing them.
Okay.
That is what analysis is about. So you compare different accounting ratios, different accounting items, different financial items. When you compare them, that's what ratio analysis is about. Let's go down anyway. What is ratio analysis? It is possible to look at a statement of financial position and the statement of comprehensive income and to draw some conclusions about the financial position of a business. However, a more precise way is to use ratio analysis. This involves taking key figures from the accounts and calculating financial ratios. There are different types of financial ratios. Two groups that will be examined in this chapter are profitability ratio and liquidity ratio. So for ratio analysis, we're talking about investigating accounts by comparing related figures. That means we check these accounts, we check the current assets of last year with current assets of this year. We check the net assets or current liability. We check the net assets or the liquidity ratio. So whatever we have to compare, whenever we have to compare different figures at different points in time, we are using ratio analysis. Whenever we have to compare figures.
Okay, to compare figures.
At any point in time in accounting, we use ratio analysis. You get that?
To compare this
figures.
Figures.
So, but here the focus is going to be profitability and liquidity. So they're starting with profitability ratio. Profitability ratios measure the performance of the business and focus on profit, revenue, and the amount invested into the business. So for profitability ratio, we're going to understand the gross profit margin, the net profit margin, and the return on capital employed. We are going to understand three things in the profitability ratio. We have the gross profit margin, which is gross profit divided by sales multiplied by 100. We have the net profit margin, which is net profit multiplied by sales multiplied by net profit divided by sales multiplied by 100. Then we have the return on capital employed, which talks about the relationship between assets and liabilities.
Okay, sure.
Okay, so we start. Gross profit margin. So for gross profit margin, it shows the gross profit made on sales. It is calculated using the formula. I said it already. Gross profit divided by revenue multiplied by 100. That is gross profit margin. I think it's clear. Clear, right?
Yeah, sure.
Then we have the operating profit margin, which is the net profit margin or operating profit. The formula for that is operating profit divided by revenue. Operating profit divided by revenue. How do we get operating profit? Gross profit minus overheads will give us what? Operating profit. Are they clear, please?
Say it again.
Gross profit minus overheads.
Overhead.
Gives us operating profit. Clear?
Yeah.
So move on. Markup. Are you there? Are you there?
Yeah, I'm there.
Okay. So that's for, I think the point is clear about that. So for markup, it is, so we have what we call markup. Markup is part of our gross profit and net profit. For markup, it simply means the cost. The profit per item divided by the cost per item multiplied by 100. That's the formula for markup. Profit per item divided by cost per item multiplied by 100. That's how we get our markup. Are you with me?
I'm with you.
So for markup, it is used by business to decide or to decide the profit made per item. So the interest on business when they use markup is to know or to understand the profit made by each item, made when they sold or when each item is being sold. That is what markup is. Clear?
Yeah.
Then we have the markup percentage, which I just talked about. Then how do we get our markup? To get our markup, it is the price to get markup is cost, the cost plus cost multiplied by the markup. Markup is, the formula for markup is profit per item divided by cost per item. That is formula, right? Profit per item divided by cost per item multiplied by 100. That is the markup. Clear that one?
Yeah.
Then how do we use markup to get price? Because we use markup is just the amount we have to add to to the price of the product to be able to make profit. That is what markup is. The additional money we have to add
Which price
to sell the product
sell the product
is what we call markup. Is it clear now?
Sure.
So markup, as we know, markup, the formula for markup is profit per item divided by cost per item. Then how do we get, when we get, as soon as we find that figure or that value, we use it by multiplying it with the cost, then adding it with the cost. So cost plus cost multiplied by markup percentage is our price. Cost multiplied by cost plus markup percentage is our price. Cost is the amount of money we invested into the business. That is cost. Then markup, we said, is profit per item divided by cost per item. Profit over cost.
Okay.
Then we have margin. We have price. And to determine price, because markup will give us the amount we have to add up to the price. So for price, it is cost plus cost multiplied by markup. Cost.
Profit is cost.
Price. The price that the product will be sold through markup is plus cost plus cost multiplied by markup. We know how to get our markup, right? And whatever we get as our markup, multiply it by 10. Or by the cost. If it is 10, if the cost is 10, you multiply it. Then you plus it with 10 again. That is if 10 is the value of the cost. Is it clear?
Clear.
That is about markup. So markup gives us the price at which we will sell and still make profit.
Sure.
Any question?
Understand?
Okay.
So we have liquidity.
The concept and importance of liquidity. Okay?
Okay, sure.
Alright.
Come on. Sorry, mister.
Are you done? Are you done now?
Sorry. My PC process
Okay.
froze.
Yeah, we're hanging on. It's okay. I paused the video already. I'm waiting. I'm waiting. Yeah?
I'm still waiting.
Okay, it's okay. I'm here.
Which page are we?
Page?
Yes. Page what?
Hold on, please.
Mister?
Ready?
Yeah.
Okay.
Like which page?
Our page?
Yeah.
Page 256. Going to be 257.
Asset test ratio.
Yes.
Okay. Yeah. Okay, let's start.
Okay. Ready?
Mm.
Alright, great, we move on. Acid test ratio, we did that, right?
Mm.
Right?
We know.
Acid test ratio, we did. I explained acid test ratio. Current asset minus inventory divided by current
Say
liability.
it again.
Acid test ratio.
Mm.
Current assets minus inventory divided by current liabilities. We talked about it.
Mm.
And the last one is return on capital employed. ROC, ROS. That's it. Did you get it or not, please?
Yeah.
Alright. So we go on to ask for ROS, return on capital employment. For ROS, return on capital employed, it's simply talking about profit of a business as a percentage of the total amount of money
What?
used to generate. Money is being employed. Money is being the business has funded. The owners of the business has funded the business, right?
Mm.
Money is being generated to to carry on business activity.
Sure.
Okay, so the amount of money invested into the business by the owners of the business would need to be returned, not the permanent capital, but in terms of profit.
Sure.
So return on capital employed is simply about the return on investment.
Mm.
That is what return on capital is.
Yeah.
Return on investment.
Investment.
And the formula for ROS is operating profit divided by capital employed multiplied by 100. Operating profit
Mm.
divided by capital employed multiplied by 100.
That's operating profit divided by capital employed times
100.
times 100.
That will give you return on capital employed.
Mm.
Is it clear? Is it clear, please?
Sure.
So using ratios to make comparisons. Are you there?
To make for comparison.
Are you there?
Yeah.
Ratios can be used to assess the performance of the performance and liquidity of a business. At a particular point in time. It can also be used to monitor the progress of a business over time.
Mm.
The statement of comprehensive income and the statement of financial position both show the figures for the current financial year and previous financial year. This means that ratio can be calculated and completed immediately. So one of the uses of ratio analysis is that we can use it to assess, to measure the performance and the liquidity of the business.
Say it again.
We call them ratio analysis, like ROS, return on capital employed.
Mm.
This measures when your return on capital employed is increasing.
Yeah.
It means the profit made by the business is increasing.
Oh.
So that is about performance of the business.
Sure.
Then liquidity of the business, we can use the current ratio.
Mm.
Current asset divided by current liability.
Mm.
So if our current asset is increasing, our current liability is reducing, it means we are having more of cash available to us.
Sure.
That is what the point is saying there. Is it clear?
Yeah.
The second paragraph. Ratios can also be used to make comparison between businesses in the same industry. Another reason why another usage of ratio analysis is that you can use it to compare, you can use it to measure your business based on your competitors. How well you are doing compared to your competitors. You can use it for comparisons.
Mm.
The first thing about ratio analysis is that you can use it to measure the performance of a business. You can also use it to measure the liquidity, the extent of liquidity of the business. That is ratio analysis.
Mm.
Another point here is about comparing your business with those of your competitors. You can use ratio analysis to compare your business with those of your competitors.
Mm.
Is it clear?
Sure.
Any question about that?
No.
So that ends chapter 31. So we have multiple choice question. Shall we?
Okay, sure.